The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday afternoon, and we're going to be talking about money. So I was at a conference this week. I was back in Boston, Asset Managers Conference, talking with a lot of asset managers and people that are pretty well known throughout the country. And it seems as though, once again, running into this whole thing of a bimodal concept or a bimodal group of money managers. Talked about this before. Adam Smith wrote the book, The Money Game, back in the 1960s. He talked about what was going on then. I believe it's going on today. He talked about the kids market, and I believe we have a kids market going on today. Maybe devolving a little bit. It's not what it was in the last couple of years, but over 50% of mutual fund managers are under the age of 30. 50% under the age of 30. And what that means is those mutual fund managers were in college or in high school when we went through the Great Recession. And it's one thing to read about it, to study it. It's another thing to live it. It's a thing when you're going through it and you're watching your neighbors lose their house, when you're watching your neighbors lose their job and can't find a job. They look. Unemployment runs out. They're living off savings or whatever. See children move back into the house with their parents. See kids graduating from college, can't find a job. It's one thing to live through it and experience it emotionally and completely through, and another thing to study it. And so what you have is young mutual fund managers who have studied it academically, and they're charging forward. But for an older group, an older population of money managers, they've seen it, they lived it, they fear it to happening again. You hear it, CNBC, when you listen to that, when you listen to some of the managers and some of the brokers on there, you can hear the fear when you're going through a time like we're going now. And at this conference, it was similar. Most of the managers were older managers. They've been around for many years. And I started to call this program today, The Good, the Bad, the Ugly. Because I don't agree with a lot of what the older managers say. I tend to agree with the younger people. But I want to present, because I think it's worth understanding where the older people are coming from and what they're saying. I disagree with it, but I think it's worth listening. And so today, I want to talk about the bad and the ugly to begin with. I don't agree with it. And then I'll get to the good, because I think there is good. So one of the managers from Double Line Fund, Ignacio Sosa, summed up probably the negative aspect. He talked about normally when the economy is running normal, Fed funds are at 2%, 10-year treasuries are at 3.5%. You look at what's going on today. We have Fed funds rate at 0. You have 10-year bonds at a very low rate. We actually issued 30-day treasury notes at a negative interest rate. People have to pay to own those. So what's going on? I mean, from his standpoint, U.S. Treasuries, and he's right, the short-term rates are controlled by the Fed with Fed fund rates and the discount rates. Long-term are set by the market. The U.S. Treasuries trade 24 hours a day, 7 days a week, 52 weeks of the year. They're constantly being traded worldwide. And so it's the market that sets those rates, not the Fed. And so when you see the 10-year bond trading at 2%, you know that there's something going on. The market is looking at very low rates. And that was one of the questions he raised. It doesn't look like anybody's anticipating that the U.S. economy is really going to take off. And when the economy is running well, he pointed out, the U.S. economy should be running at around a 5% GDP, and right now we're running 2.5%. He talked about that. He talked about China and the deflationary pressures and the reasons that the Fed shouldn't raise rates. He talked about China. He said China, in his opinion, was like 1929. He follows the Li Chang index rather than the official GDP because the official GDP is set by the government, and surprise, surprise, what the government sets, the economy usually achieves. But he looked at the Li Chang index, which is for the last 12 months is running at around 2.5% versus 7% for the GDP. And he felt it was probably going to go to zero. He looked at the meltdown in commodity prices, not just oil going from over 100 to 40, but every commodity, copper and steel and aluminum, foodstuffs. Commodities have taken a huge drop. They're dropping off the edge, metals and gold. He raised the question, will the Glencore be the next AIG or Lehman in the commodities field? He could be right on that, by the way. Junk bonds, the prices are diving on junk bonds. Again, talked about that, and while I don't feel that interest rates are really connected with junk bonds, it's the point. European and Japanese rates are low, personal consumption is down. He felt that the 5.1% unemployment rate did not represent the reality. He felt a lot of people had given up looking for work. I disagree with a lot of what he said. When I look around Seattle, what I see all over the place are help wanted signs. In Boston, it was help wanted signs. When you look at a lot of the country, it's help wanted signs. And yeah, it may not be true in that Minneapolis southern area down, but the U.S., I believe, is going. That's the negative side. I don't agree. The other side, to a large extent, was expressed by Richard Bernstein. I've talked about Bernstein before. Bernstein is the guy that said a few years ago that he felt we were entering a time which was going to be the greatest secular bull market of our lifetime. Mentioned that a number of times on the radio because I've been saying the same thing. I've been saying that since 2009. And Bernstein before made a number of parallel or things that were very similar in the 1980s to what we were experiencing in the 2009, 2010, 2000 time frame, even today. And while history doesn't repeat, I believe that it rhymes. But he quit talking about it because so many people were upset over what he was saying. And as we talked about that, the feeling is that investors today are probably confused. They're confused about symptoms and a problem. When you have a headache, it's a symptom. It's not the real problem. You take an aspirin, you treat the symptom, but the headache could be from any number of reasons. That could be the problem. The headache is the symptom. Could be a cold, could be a flu, could be multiple other things. The headache is a symptom. Talking today, what we're looking at, what we're confused with, what we're seeing are primarily symptoms. And the symptoms are all related to underperformance of credit-related asset classes. If you look at gold, which is down, if you look at commodities, private equity, the emerging markets, hedge funds, the real estate investment trust, and China, those are all related to a credit bubble that burst in 2008. And we're undoing the credit problem. We've got an ongoing deflation. We're popped the credit bubble, and now the effects, we're seeing that. The credit bubble, in my opinion, started growing probably in the 1970s. Bernstein thinks it was closer to 1998. But that was a time in which times were really good, things were growing, and through this whole period of time of the early 2000s, we saw companies building new plants, we saw China exploding, we saw the rest of the world building, and economies that depended upon commodities were selling iron ore, they were selling their copper, they were selling their bauxite, they were selling their gold for what they could get, and the prices kept increasing, and they kept doing more mines, they kept doing more plants. Private equity reached out and was furnishing a lot of money to a lot of these places. The emerging markets continued to grow fast. We don't have to look too far to see the impact of what's gone on. We only have to look north to Canada. Canada is very much a commodities-driven economy. The oil, the forest, the commodities coming out of there. At one time, the Canadian dollar traded at a 20 or 30% premium to U.S. currency. Today, it's not anymore. So we have this bubble. And what we live in today is probably what Bernstein called a Wal-Mart world. When Wal-Mart goes into a new market, they look at their competitors, they cut their prices, and they underprice everybody, and they take market share. What we're seeing today is the world awash in a supply of overcapacity. We're coming back to a commercial break. Don't go away. I want to continue this talk because I think it's important to understand where we are and what this correction is about, what this market is about. I think we are in the greatest secular bull market of our lifetime. But we'll talk about that after the commercial break. Don't go away.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
Answer. We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
I've been talking about the bimodal population of money managers. One group feeling that things are going to go bearish again. Another group feeling that we're really in a correction. I'm in the correction side of the whole equation. And as I was talking to Bernstein, he labeled a Wal-Mart world. Wal-Mart goes into a place, they undercut the prices, they gain market share that way. And today the world is awash in an oversupply of capacity. There's capacity everywhere. There's been so much building going on during this whole credit build phase from 1998 until 2008. There was so much credit you could build everywhere. And that's what was happening. It was a build, build, build. It was a classic situation. It was economics 101. And what we're going through today is economics 101. When you have greater capacity than demand, what happens to prices? They go down. When countries face overcapacity, what do? They devalue their currency. That's what happened in China. They've got overcapacity. People talk about commodities prices and China's not buying anymore. They've got overcapacity. So what are they doing? They're dropping the value of their currency. And they probably will do it again. And they're not the only one that will do it. All those are bullish factors for the dollar. The U.S. is the biggest consuming nation in the world. Everyone wants to do business here. So with overcapacity, you don't build market share, increase market share by raising prices. You build market share by dropping prices. And that's what we're seeing. The emerging markets, commodity-based countries are having to drop prices. They're bringing down prices. And that means a rising dollar buys more than it used to. That's good for companies because they're making things cheaper. It's good for consumers because we're going to be able to buy things. One of the few times in which the situation is good for businesses because profits will rise, and good for consumers because prices will drop. You know, with all that going on, it looks like a correction. It's not a bear market. We're working off the excess capacity. And as the excess capacity, as the economy grows here, economies are growing worldwide. As the economies grow, they'll use that capacity. It's going to take some time. Eventually, things will bottom out and things will start to move the other way. We went through that last secular bull market from 1982 to 2000. We went through corrections there in 1987. I remember the time and the fear of that. I'm going to talk about that in the last segment today. But we went through those kind of fears in 87. We went through them in 89. In the 90s, we had corrections. Corrections are something that are a normal thing. And everybody worries because we went through the Great Recession that we're going back into that. There is one shock, I think, that's coming. I think it's coming sometime next year. It's going to kick again the market because there's a lot of interest in going after beaten up oil stocks, distressed stocks. Private equity has raised $52 billion to go after distressed energy. $52 billion already raised in cash to buy distressed energy assets. Now, if you look at the Standard & Poor's 400, the market cap of all oil companies, total, in the Standard & Poor's 400 is $80 billion. So already, private equity funds have raised 65% of that market cap to buy distressed oil things. But if you look at the assets of oil companies, oil prices have come down since last August. They've come from over $100 to $40. But if you look at the books, if you look at how oil companies are treating this, assets on oil company books and oil-related company books are increasing. The assets are increasing. To me, what that says is they're carrying their reserves, they're carrying their inventories as if the drop in oil prices was something that was a relatively short-term thing, that they expect oil prices to recover. So they're carrying that at a high price, at $100. And what that means is sometime next spring, or maybe next fall, or a year later, the auditors are going to look at that and say, you have to mark your reserves, you have to mark your inventories down to fair market value. And all these profits that these oil companies have been showing, the tremendous amount of profits they're showing, they will have to take a very significant write-down, which could wipe out their profits for the last few years. And it will wipe out their prices. Now, it's just a guess on my part. It's just a guess as to what's going to be true and what's going to happen. But we could see a significant number, or at least a few, oil companies filing Chapter 11 or Chapter 7. And I think that will impact the market. So where am I? I feel that we're in a correction. We're not in a bear market. We're not headed for a bear market. We're in a correction just as we were in 1987, just as we were in 89, just as we were in 1991. There's issues to overcome. We're unwinding this credit bubble we went through. That's going to take some time. It's going to be difficult, especially for emerging markets. I think it involves being in the right place and understanding the problem and not getting confused with the symptoms. There's big benefits for that. And it's being in the right place at the right time. That's my take on the whole thing. That's a correction, not a bear market. My guest today, I want to turn and talk. My guest today is Stanley Hainsworth of Tether. So welcome to the program, Stanley.
Thank you, Mike. It's great to be here.
So let's start with your background.
Sure.
Tell us about your background.
Yeah, I guess I've had a blessed career, and unexpected, like many people's career. They start in one area and end up in another. I was an actor for several years in New York and LA, and then I kind of fell into this career in this design and advertising world. I started working at Nike back in 1989, and I was there for 12 years, and then I moved on, became a creative director there, and then I moved on to Denmark, where I became global creative director at Lego. That sounds like fun, doesn't it?
Yeah.
Yeah, and then
Putting Legos together.
Yeah, and then from there I went, after 4 years there, I went to Starbucks, and that's how I ended up in Seattle, became the vice president of global creative there at Starbucks. And after 4 years there, I decided to go out and start my own company, and that's Tether. It's a creative company where we do design and advertising.
So how did you get to the name Tether?
Tether, I was looking for a name that spoke to that connection, that emotional connection between consumers and brands. And, naming your own company, it's like naming your child. I remember naming my kids. I have 5 kids. It was a huge decision because, you're saddling them with something they're going to go through their life with that they didn't get to choose. So next to naming my children, naming my company was the next hardest. So I wanted that name to speak to that emotional connection. And I thought, Tether, that's a great name. That's a great name. That tether, it's flexible. It can, kind of like a tetherball. It's attached to a rigid pole, but it can move and be flexible.
So let's talk about Tether and what Tether does in terms of your marketing and what you do.
Yeah, really about companies come to us, whether they're an older company that they might have started in one area and they might have originated a category. And I'll use Gatorade as an example. Gatorade came to us, and they were a 45-year-old company, and they originated hydration, the hydration beverage category. But there's a lot of competitors coming up, and they came to us to look to re-energize the brand and to help reposition the brand. And so we did that, more around fuel for your body. So it's more than just hydration. It's before you work out, after you work out. It could be food, it could be services. And we were able to then do the redesign of their products as well. So what you see on the grocery store, you see on the sidelines, the equipment on the sidelines, what you see the athletes drinking. So we do industrial design, we do branding, we do packaging, we do digital, we do advertising, promotions. So anything that touches the consumer, all the consumer touch points to create that emotional connection.
That's interesting.
Yeah.
So as you do this, I know it's a creative process, but how do you integrate with the companies themselves?
One thing that I think has been an advantage is that I was in-house for so many years. I was on the client side or on the corporate side. So I worked inside the company. So I really understood the nuances and the processes of getting internal buy-in around concepts. And so as we work with companies, with corporations, we're able to bring to bear that type of understanding, that type of knowledge. So what we do as we're working with a company is we kind of suck everything we can out of their brains. Tell us all about your industry. Tell us about your company. Tell us about your problems. Tell us about your challenges and your opportunities. And then we take that information and then we bring our a little bit of ignorance to the table because we don't know everything that they know. But we love to ask those what-if questions. It's like, what if you did it this way? Or why don't you try it this way? And so we're able to ask questions that maybe they wouldn't have been able to think of because they're living inside that. One way that you can think of it is when you are working for a company, it's kind of like joining a religion because you have to learn all the nuances of that company. And as marketers or as designers or creatives working inside that company, your job is to get to get converts to that company.
We're going to come back in just a minute. We're coming to a commercial break, and so hold the thought, hold the comments. We're going to be right back after this commercial break.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Stanley Hainsworth of Tether. We had just started to talk about what they do in preparing a company. But what type of companies do you work with? Big, small, in between?
All of them. It's really fun to have that diversity. We work with large companies like PepsiCo, brands like Pepsi. We did the redesign of Pepsi or Gatorade, those that I mentioned, or Microsoft, Amazon, etc. But we also work with little startups, and those are lots of fun. And that's one of the joys of having a company like Tether is it's really a creative playground where we can just take an idea. So an entrepreneur comes to us and they said, we have this great idea. I'll give you one example. They came to us and they said, we have a great idea to do caffeinated chocolate bars. We thought, what? Caffeinated chocolate bars? They go, yeah, we have this method that we've come up with where one chocolate bar equals 1 cup of coffee. So think of it as an afternoon treat. Instead of having a cup of coffee, you could have a chocolate bar. And we thought, wow, that's kind of a good idea. No one's done that? No one's done that. So they didn't have any money. And so we took shares in their company. So we did an equity swap. And we do their creative work in exchange for shares in their company. And it's worked out really well where we did everything from their identity to the website to the packaging, the chocolate bar itself, and then the promotions around it. So that's how we are able to work with some of these little startups, people that you meet randomly or through friends or through connections. And so we have this kind of diverse portfolio of large, medium, and then startups. And we've also started some of our own brands or products as well.
So when you say your own brands, the chocolate people should be on the radio show. I would like to have that. But anyway, that's on the side. When you say you started your own brands, tell me about that.
Yeah. I met this, life is really about all these connections that you make. And they're usually people connections. And you've always, we've all heard over the years, it's about who you know. And it really is. When you're looking to get your first job or your 10th job, it's about those connections because everyone wants to work with people that they like, and of course people that are more than competent, that they're great at what they do. So when I was at Starbucks, I met this amazing woman. Her name's Victoria Tsai, and she was the business person on a product that I was working on the creative side on. And we got to know each other through working on that project, and we were launching it in China. And so we spent quite a bit of time together and learning about each other. And so when we both left Starbucks, we toyed around with this idea to start a beauty company. The idea is to bring Japanese beauty secrets to the rest of the world. And she was in the beauty industry before Starbucks, and so she has experience in that area. And we started this little company called Tatcha. Tatcha, it was almost 6 years ago, 5 or 6 years ago we started it. And that little brand now is Inc., the top 100 fastest growing companies in the Americas. It's number 21. And it's also the fastest growing beauty company in the world.
Congratulations.
Well,
that's quite a story.
Yeah, so as a co-founder of that company, it's very fun to see all those practices that we put. We've done that for big companies like Starbucks and Nike, etc. But to do it on your own brand, that's a whole different story. You're a little startup. How do you do it in a scrappy way? You don't have big budgets. Who do you target? How do you get the word out? So that was really fun to put, I guess, your money where your mouth is.
And you do that even with the startups when you take equity, right?
Of course, yeah. The whole goal, now I'm a shareholder in the company, so I want to see my shares grow as well. And so I want to do it. I want to use the money that company has in the most efficient way possible, so that we can save money. We need it for manufacturing. We need it for marketing. So we do it in the most cost-effective way.
That's incredible. And beyond startup companies, seed companies?
Yeah. Another thing that has been fun is there's someone that I've worked with over the years, and again, it's people that you know. There's a person that I worked with at Nike and Lego, and we've continued doing work together, and his name is Andrew Black, and he's an amazing guy, and we worked on a couple projects together at Tether, and then there's a company that we started called Brand Project, brandproject.com, and we've raised seed money. We've raised a fund so that we can do seed stage investments now with some of these companies. So we find these entrepreneurs. Before it was just about doing design for them or doing business advice, and now we're able to actually fund them as well. And Andrew does the strategic, the business analyzing the business and the business growth and sales and all those things. And then at Tether, we're able to do all the creative for them.
Fantastic. So with so many startups, how do you select which ones you will do and which you won't do? Or is that an issue?
Yeah, there's been a lot of learnings over the years, because it's fun at first. You go, oh yeah, I'll work with you because I have this amazing team at Tether. We can do anything for you. Well, I learned lessons along the way. And one is that you need to limit hours, because they'll just eat up all your time. It's like, ooh, I got this whole agency that I can do anything I want with. So you have to treat them like a client, even though you're more of a partner with them. And also I did get a little overloaded at first. I had a few too many of these equity companies that I was working with, because I have about 75 employees. I have to pay the bills. I have to pay the overhead, the salaries and all those things, and equity ones don't pay that much or at all. It's all future value that you're investing in. And so yes, so now I'm very rigorous. I go through kind of a checklist, both interest, areas that I'm interested in or businesses that I'm interested in, but also their potential for growth. I look closely at the marketplace and see what competitors are out there in the market, possible white space. Is it a disruptor brand that can disrupt a category that is stale? So there's a lot of little checkpoints that I go through now.
It's awesome.
Yeah.
So if somebody wanted to get a hold of you, how would they do that?
Well, you go to our website. It's tetherinc.com, and there's a contact place there. And it's been really fun to just run into people randomly in an airport, and you end up working together, or speaking at conferences as you do, and finding people there that have a like mind. So I've written books, and it's all about making yourself available out there to see what opportunities come up, because as you know, life is short. Let's find people that are excited about building brands or building stories together, and let's do something fun
and enjoy life.
That's it. Yeah, exactly.
It's really great. Thanks for being on the program.
Thank you. It's been a pleasure.
Tether's quite a story.
Yeah, it's Seattle-based, right in Pioneer Square, and we also have a Portland studio. We still work with Nike and other brands that are in the Portland area, and that's been a lot of fun as well. So kind of getting the band back together, the brands you used to work with, the people you used to work with, a lot of fun.
That's great.
Thanks,
and
Mike.
You do Pioneer Square too, right?
Yeah, Pioneer Square. I've been very active in Pioneer Square with the Alliance and the board, and helping to grow Pioneer Square and solve some of the issues that we have there, but also economic development. We have an amazing Pioneer Square Alliance and big rejuvenation going on right now, and we're all the beneficiaries of it.
That's great.
Yeah.
Thank you very much.
Thank you.
So I want to shift and talk about the next great big thing. This came up at the conference. The next great big thing. Now, this is something that's called goals-based wealth management. Goals-based wealth management. It is the next big, great thing according to the people who were talking about it. Now, let me give you a little bit of history. I want to go back to 1987. Following Black Monday, October 19th, 1987, the market dropped over 30% and people were frozen. It was worse than it was today. It's worse than it was with people having gone through the Great Recession, having that kind of fear, and yet having seen the market take off. People are worried, but they're not paralyzed. Back in 87, it was like investors were paralyzed. And it was a different time, too, because most of the revenues that were generated were transaction revenues. I started my career in 1986 as a stock jockey, building stock positions, trading stocks, buying one, selling one. That's how I started my career. Every time you bought something, every time you sold something, you got paid for it. If you didn't do any work at all, if you didn't buy, if you didn't sell, you didn't get paid anything. Now I run money under a fee basis, and I only get paid more if the accounts go up in value. I get paid for keeping people in stocks that are continuing to increase. That was not the way it was in 87. It was a transaction based. And, it was a time in 1987, the market came plunging down. I can remember a wholesaler came into the office and said, you're going to be able to go into Nordstrom this week. $1 trillion has gone from the economy. You're going to be able to go into Nordstrom and hear a pin drop. I went home, I told my wife, I said, we got to go into Nordstrom's this weekend. We went into Nordstrom. We couldn't get into the store. There were so many people there. I said to her, these people must not know that $1 trillion is gone from the economy. But it was a time of paralysis. And the big firms had to do something. And they did. They came up with their own unique approach to this. And it seemed like almost every firm had their own approach. I was with Payne Weber at the time. We had our own approach. Merrill had their own approach. Other firms had their approaches. And I'm going to talk about those approaches because it comes back to this latest, greatest, newest thing. So don't go away. Right after the break, we're going to talk about what happened in 87 and how that applies to 2015. Don't go away. Be right back.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I started talking about the next great latest thing. This came out of the conference, goals-based wealth management. And it reminded me of 1987 and what went on in 1987 because 1987 investors were frozen. And that was a time when we were doing transaction business, buying and selling. Stockbrokers after 1987 had such a bad name. They do these surveys that say how much confidence you have or how much trust you have in people. Stockbrokers were at the very bottom of the list, That's where we were. And the companies came up with new names. They came up with financial consultant, financial advisors, They wanted to move away from the idea of stockbroker because stockbroker was at the bottom of the list and nobody wanted to deal with a stockbroker that lost all that money. But the firms had a problem because they had to generate new revenue. How did they do that? So with Payne Weber came up with this concept of a zero-cost 6-month CD that paid a nice rate of interest, paid their stockbrokers, now called financial consultants or financial advisors, now paid their financial advisors money. It was a loss leader type product, but the idea was get the cash in, and in 6 months, you'll have cash to invest and start to trade in stocks again, start trading in bonds. You know, that was the concept behind it. Now, you have to remember that in the 1980s, a lot of the money was still in the banks. The banks had come through this period of the 1970s when CDs were paying 12 and 14 and 16%. And so a lot of people still had CDs and a lot of cash was flowing in. So the idea from the firms was to go out and get the cash. But Merrill came up with the idea of financial planning. And they wanted every one of their financial advisors, every one of their stockbrokers, to charge for it. You had to do at least one plan. And you had to charge a client $245 or whatever it cost in those days. And the concept was not to do it for free because that would make it look like it was a sales gimmick, but to charge for it and to come up with this plan, which was all computerized. You'd plug in the numbers, it all spit out all this nice plan. And the idea was to find out where all your clients had their money, what other brokerage houses, what banks, and so on, and then to plug it all together and go out and bring this money in because eventually that money was going to turn into transactions or longer down the line into fees. So you've heard it before. The idea is to consolidate your assets in one place so you can have this plan and you can plan for retirement, you can plan for your kids' education, you can do all this planning. And, we'll allocate assets so that if one asset goes down, another will go up, and we're going to get uncorrelated assets. And you've heard the story again and again. But guess what? It didn't work. 2008 taught us uncorrelated assets tend, in tough times, to be correlated, and everything goes down. And all those plans about having enough money for retirement, when the market goes down and everything goes down, you may not have enough to retire. You may have to work longer. You may have to put away more money. So the concept of financial planning moved away. Not only that, back in 1987, over 90% of the money that was managed by financial advisors, stockbrokers at the time, 90 to 95%, those stockbrokers, financial advisors, worked for the big companies, the big wirehouses, the big brokerages, the Merrills, the Paynes, the Kidders, the Morgan Stanleys, the Smith Barneys. Those were the companies that had the control over the market. Today, that's not true. They have 43%. And this whole concept is coming out. The next, latest, greatest thing. Next greatest thing. Not only are they going after something that's very specialized and changing the plan, the next generation of financial planning is what it essentially is, but they also want to go out and consolidate assets. Once again, it worked in the 1980s. They want to do it again. And the whole process is this. It's an iterated process. You develop a plan and you prioritize goals. And you don't just say, I want goal 1, 2, 3, and 4. You prioritize and you now make a range. This is when I plan to retire. This is when I would retire. Is it more important to have money for my college age kids or my college for my kids? Or is it more important to have the money for retirement? Is it more important for a second house than to have money for retirement? It's prioritizing goals as well as setting the goals. And then comes the second process of implementing. Same kind of thing as done in financial planning, but it didn't work in 2008 and 2009, but they can't come up with anything better, so they're doing essentially the same thing, with the exception that they're building models. and they're putting money into big pies and little pies. They call them big pies, little pies. And knowing that taxes are the biggest drag on portfolio expense, there's really a focus on the taxes and reducing taxes and improving performance. You know, I worked for a warehouse for a long part of my career, 18 years of my career. And the mantra at that time was to sell the relationship, not the performance. They didn't want you to focus on performance. Today they're realizing that some people are getting such bad performance that they want to move people into models and get better. And then the third step is to coordinate and select the products and the models so that you get a better performance out of the whole thing. The concept is that by letting the back office set the models and taking away some of that freedom from the financial advisors, that you should get better performance. And finally, to do intelligent withdrawals, the distribution, withdrawing in the correct method. You know, it all sounds wonderful. And they're finding that 99% of clients are happy with it. You know, the same thing was true of financial planning in 1987. But for me, it's the same issue. Selling the relationship, not the performance. Realizing that performance counts, they need to boost it. They need to continue it. And no matter how you allocate in an asset allocation, you're not going to get the best performance. Goals-based wealth management is a focus on changing how things are done, improving, and the other part of it is that it's only being sold. The people that develop this whole thing, goals-based wealth management, are only selling it, and they're limiting it to the warehouses, the very big brokerages. If I wanted to have it, I couldn't have it. If some of the smaller independent broker-dealers wanted it, they couldn't have it. The idea is to rebuild the revenues that came out of the big brokerage houses. And I think you have to go back and ask the question, why have they lost half of their market share? I think it all comes down to something that we didn't talk about today. It's talked about very negatively by the big houses. Department of Labor wants a fiduciary standard. Big brokerage houses don't want a fiduciary standard. They don't want every decision made in the best interest of the client. I think that's why the big firms are losing market share. Not every decision is made in the best interest of the client. And once again, goals-based wealth management is something that's an improvement for the clients, but it's a bigger improvement, hopefully, in the opinion of the firms. Hopefully, they're hoping that it's going to bring back market share. It's going to take money from the small firms who don't have it. It's going to bring money back into the big firms, and they're going to increase their revenues. Next greatest, biggest thing? I don't think so, but we'll see. Maybe it will be. Until next week, have a great weekend, and I will be back next week with more to share.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.